YouTube, it's Rebecca Lynn Matheson, aka the Canadian Cottage Girl, and I'm joined by the Findlay Mortgage Team, Josh and Ehren in the house, and we're doing part 2 of this video series about their latest mortgage product for multifamilies.
Purchasing multifamily property can be a challenge, and it has been because asset prices have increased while the actual income on these properties have stayed decently stagnant for the last little while, so which is causing, purchasing these assets conventionally to be very difficult. So we've created a product with some of our lending partners that allows you the flexibility of your term, your rate, able to use collateral, true flexibility in being able to reposition an asset based off of your viability in being able to complete a project. We're really excited about it, and we're hoping that we can help a ton of you guys get into some multifamilies this year.
So let's talk a little bit, a brief overview from the last video, but if you want the full details on the purchase side of this product, make sure you check out part 1 of the video, and we're going to have a link or pop-up box somewhere in the screen here for you guys, and just make sure that you check out part 1 if you want the full details on this product. But we'll give a brief overview here to start, and then we're going to get right into how you exit and refinance out of this product. So Josh and Ehren, welcome to the channel. Let's get right into this product.
Yeah, thanks for having us back. I think we're just talking a little overview first about the product. If you guys, again, haven't seen it, check out the whole video previous to this one. It outlines everything in greater detail, but essentially this product is specifically made for the multifamily market in Ontario at the moment. Purchasing multifamily property can be a challenge, and it has been because asset prices have increased while the actual income on these properties have stayed decently stagnant for the last little while, so which is causing purchasing these assets conventionally to be very difficult. So we've created a product with some of our lending partners that allows you the flexibility of your term, your rate, able to use collateral, true flexibility in being able to reposition an asset based off of your viability in being able to complete a project. We're really excited about it, and we're hoping that we can help a ton of you guys get into some multifamilies this year.
Yeah, so speaking on the refinance part, the best part about working with us is that when we run the initial numbers on the purchase, we're going to take a look at the refinance as well. So, one thing you should always do is when you're taking a look at apartment buildings and you're taking a look at repositioning, making sure that your target NOI, your target gross are going to be in a position for you to be able to refinance out. Because it's great if you go through the product and you go through the renovations, you put that money into it, but if you're under where your rents need to be, it's definitely going to have some issues in terms of refinancing what your loan to value is going to be. And when we're looking at the size of some of the multifamily loans, it's a lot to be able to cover out of pocket if that loan to value comes in short. So one thing we'll always do when we're running the purchase numbers is we're going to take a look at the refinance numbers at the same time and just let you know, hey, you need to be able to get rents here, or with your rents that you're targeting, you're going to have lots of room with the market cap and where you're looking to refinance out on.
Yeah, so when you're first running your numbers, if you guys don't know, commercial financing is based off of something called a debt servicing coverage ratio. And this ratio looks at your net operating income divided by the total annual mortgage payments the property can support. And that ratio is how the banks assess, is your property a self-sustainable asset. We're looking for a ratio of 1 to 1.2, meaning for every dollar it's costing you, you're making 20 cents on that dollar. Now, depending on where you're buying, the bank you're using, the type of asset you have, that those expenses that we're going to use are going to vary depending on all those different aspects. So really important to understand the bank you're planning on using when you're refinancing, because each bank has their own specific way of underwriting multifamily assets, and that's where the true value of Ehren and I come in. We don't work with one bank, we work with all of the banks, and those banks have different intricacies, different vacancy rates, different management costs, some use actual expenses, some use benchmark expenses. So understanding how that's going to really play out on the back end of your deal is actually way more important than the acquisition. Buying a property is really easy to do at the end of the day. If you have the capital to do it, I can find you a loan. That's not what's hard. What's difficult is being able to position this in your portfolio as a self-sustainable long-term asset that's going to give you cash flow and allow you to continue to recycle your capital and buy additional buildings.
Absolutely. Something that I want to just highlight that both Josh and Ehren touched on is that a lot of traditional lenders, they want your business, and they also want you to stay using their product for a long period of time. So by using this repurposing product and also just working with a mortgage agent that is advocating for you and on your side, it allows for them to really understand what your goals are. And really, this product came to be because you guys are investors yourself. You understand what multifamily investors are looking for, and you wanted to create something that is short term so that you don't use the product forever, so that you can create that lift, create that value in the multifamily building so that it can be refinanced out to a better rate. You don't want to be in this product forever. So that's why this exiting strategy is actually really important, that both Josh and Ehren are fully aware it needs to happen from this product, and actually are going to be encouraging you to think about before you even enter into this product. So let's break this exit strategy down a little bit more and just really get a great understanding of what that process might look like from an investor's standpoint.
So when we're looking at the ARV value of your property, as I said in the previous video, we're going to have an as-complete value and we're going to have an as-is value. Now, your as-complete value is going to be based off of market rent projections in the area and how many units you're going to have at market rent at the time of refinance. And that's really the most important aspect of repositioning a building, is how high can you get your net operating income to support the equity takeout on the back end of the loan. So when we're looking at your DSCR ratio, we take a look at your gross income, so all the rent you're making annually, and then we deduct some fixed expenses. So we deduct your property taxes, which can be verified through property tax statement, your utility costs. Now, there's some strategies around turning utilities to the tenants as you're repositioning the building, which can lower your expenses. We're going to take a look at your insurance costs. So your insurance costs are a generic cost. Some, depending on where you go shop, you can really reduce that expense as well. And then we're going to take a look at vacancy management, maintenance, and all those things, all of the vacancy management maintenance are different based off of location and bank. So some use a 4% management cost, some use a 5% management cost, some use the actual true management cost. So if you're in an area where you're paying 10% for management, for example, I can't get away with using a 5% management cost. We're going to look at the historical expenses as well to ensure that the benchmark expenses that we use are in line with historical expenses on the building, because some buildings have more maintenance than others. Some are in maybe Northern Ontario, which costs more to be able to maintain the building than maybe Southern Ontario. So, when we take a look at all of these expenses, that'll give us our net operating income and our true net operating income. So when you're dealing with a realtor or somebody who's giving you numbers and they're not giving you the vacancy, the management, or the maintenance costs built into your numbers, that is a serious issue when you're looking at trying to figure out an exit strategy. So understanding those are minimum requirements when trying to assess your viability in your pro forma. Once we have your net operating income, we try to figure out, usually, so for multifamily property, the maximum loan to value you can refinance out at is 75% loan to value for multifamily commercial buildings. There are some exceptions at 80%, and then you get into CMHC at 85-90% loan to value, but conventional expects 75% loan to value. Now, what we're going to do is we're going to take a look at what is the current qualification rate at a 25-year amortization based off of the economic life of your building, and how much debt can that property support annually. And then we'll try to figure out at 75%, can the net operating income support it? If it can't, then we'll reduce the loan amount until your DSCR ratio is at 1.2%. And at that point, that will tell us how much debt the property can support based off of the new net operating income. And it's really important to go through this exercise once you have your as complete valuation to understand how much capital you're going to have stuck in your project, because odds are you're not having a perfect BRRRR on a multifamily building anymore. So being comfortable understanding how much money you have in this project is going to allow you to be able to recycle your capital or whatever capital you have left to go and do this again.
Absolutely, yeah, I think that's a really good point, is just understanding the actual numbers on the individual building based off of the location and just the building's performance. Because it's one thing to make assumptions about the numbers for management fees and just maintenance expense, but to actually have the historical data really tells a lot more information. So it is important that you get that full picture so that you can do some of those projections and know what capital you're holding on to in that building.
Certainly, and again, it's really important for our lender to understand this aspect of the acquisition financing as well, because they're not going to give you the loan if we don't have an exit strategy that is viable with a bank. So they're going to lean on us to be able to give them accurate projections of your ability to be able to do this. And we use third-party assessors to give us CMHC market rents, understanding historical expenses, to really dial it in. So not only are you getting the acquisition, you're also getting a map plan of being able to get out of this product as well, which as Erin and I say all the time, it's important for us to be able to help you move forward with your investing journey and scaling your portfolio. So that's kind of like the secret sauce.
Absolutely. Now we talked a lot more about the timelines and just certain different elements in part 1 of the video. So make sure, again, if you haven't seen part 1, that you check that out for the full details on the purchase side of this product. But in this plan, you mentioned kind of mapping it all out, and we might have an expected timeline on this plan. Maybe it's under 6 months. One of the things that I love that you mentioned in the first video was just that you can actually extend that without that penalty with this product, but still have a plan in place from the beginning on this refinance. So let's break down that exit strategy even further.
Yes, I think one thing I want to touch on, just what Josh said with the expenses, and it's really important that we get seller verified expenses. Ideally, we're getting 2 to 3 years of accountant prepared notice to reader financials. And if you're going direct to a bank, a lot of banks, like big banks, will put a lot of emphasis on that for a few reasons. One, your vacancy rate isn't going to be 1 to 2%, and I do see a lot of investors using that. Like, we understand that it is low, but there isn't going to be a lender out there who's really going to allow you to get away with a 1% vacancy rate. It's just they want to be realistic and have a bit of a buffer. But two, taking a look at those expenses. And the income. How many times I've seen an income statement come in from a realtor or from a wholesaler, and it's using market rents. And then when we get the actual rent rolls, we realize that we're actually off by $5,000 or whatever it is annually, and that makes a bit of a difference. So when you're getting these statements, try to get accountant prepared statements, sign rent rolls, making sure everything's up to date so that we have the exact numbers and we're not running numbers, going through LOIs, getting things done, and then realize, hey, we're not actually using the correct numbers. These are projected expenses. So really important to make sure we're using verified information. Another option on the refinance, Josh talked about some conventional non-insured options. CMHC is another option that you can go down that route if you are looking to do the refinance. There's a few things to be aware of if you're doing the CMHC options. First is going to be, what are you able to use that cash takeout for? Because you are limited when you're working with CMHC. So when you go through a CMHC refinance, you can't just take that cash and do whatever you want with it. You're not able to buy out your investors anymore. You're not able to just put it in your pocket, go buy a car, go buy whatever you want. They want you to take that money and reinvest it back into the multifamily market. So there's a few things you can do. Refinancing in general, whether it's out of an acquisition or just a pre-existing building, can go into renovations, and it's not to reimburse renovations, it is to go into the renovation. So they're going to want to see a plan, outlines cost, who's going to be doing the renovations. They want to see all that up front, verify the expenses, and then release the funds and allow you to go through with the renovations. The other option is buying into additional multifamily. So again, taking that money, reinvesting it back into the multi-unit space, not just putting it into your pocket and kind of doing whatever you want with it. Now, you do have some flexibility with the timelines, and you have about 2 or 3 years to be able to redeploy that capital. And the CMHC process is really just based on faith and trust. You have to be able to show to CMHC that at some point you've taken that capital and you put it back into the market. And if you haven't, your next time you go through the application, it's going to have a dark shadow over you. And if you keep kind of going through that process and not using the funds in the correct timeline, eventually you're just going to get cut off from the CMHC financing. So just important to note that. With CMHC, they do take a look at the expenses a little bit different. They take into consideration inflation. So they're going to take a look at a 3% inflation cost on all your values. So again, if you're trying to run numbers by yourself, making sure you're trying to include that 3% inflation. We have the spreadsheets and stuff if you're looking at it. They take a look at some of the management and other fees a little bit different as well too, where some lenders take a look at just 5% of revenue. CMHC does based off of per door. So you're looking at like $750 or $800 per door for some of these costs. So it is a little bit different. And the debt servicing is a little bit different. On the conventional side, if you're a really strong borrower and a great looking building and you just couldn't get that debt servicing to 1.2, maybe you're at like 1.7, we can still get that done on the conventional side. But when we're going with CMHC, they're looking at 1.2 to 1.3% depending on how many units and the type of term that you're looking for. So that 1.2, 1.3 is going to differentiate again, the type of building and how long your term is going to be. And that's important because if you're stuck in a 10+ year term, you're in there for 10 years. It's very strict, it's very rigid with CMHC, it's very expensive to break. So a lot of people I would assume would want to be in that sub 10% 10-year term. So making sure those numbers are at that 1.3% is really going to allow you to dial it in. With CMHC, depending on who your original lender is, sometimes can create some complications going into CMHC refinancing. So if you've done private financing, a lot of the lenders out there who initiate the CMHC refinance want that original private lender to be signed up directly or have access to CMHC financing. Now there are some private lenders out there who are directly approved and verified with CMHC, which makes the process a little bit simpler. You can go in and exit out directly with that lender and it's kind of all one shebang. There are some other lenders out there who are private that aren't signed up directly with CMHC. So just be careful and make sure you understand kind of what the implications are going that route. Timeline for refinancing out of CMHC is a lot longer than what a conventional mortgage is going to take with just a regular lender. Typical refinance, we could potentially get it done in 2 months if you wanted just a comfortable timeline. But when we're taking a look at a CMHC, you're taking a look at anywhere from like 18 to 20 weeks right now. It's backed up, it's busy, there's a lot more that goes into it. The timelines, it's not the same. So if you're coming up to your 1-year term and you're 2-3 months out, you might have to take a look at exiting into just a conventional product, get into there, get out of that exit, get out of the private and reduce your costs, and then reapply into CMHC, give yourself some timeline to be able to go down that route. But it is not going to be just hey, I'm coming up on my 8 or 8, 9, 10th month and I want to get out at the end of the year, let's go into CMHC. It's not that quick. It is a lot more complicated. One other thing to be aware of with CMHC is they do their own valuations. So they're going to take the lesser of the appraisal and CMHC's own internal valuation, and there are a lot of stories of where CMHC's values do come in a bit lower than the appraisal, and that's the value that they're going to go off of. So just be aware of that it's not always going to be where your appraisal comes back. There might be some instances where CMHC's values are a little bit less, and you're not going to get that full value as expected. Now the nice thing with CMHC obviously is that it has higher loan to values, so you can get anywhere from 85 to 90% loan to value, which even 95% loan to value, which can help to make up for that small difference. But again, just being aware that is a possibility with the outcome. CMHC has a few different options. They have their standard rental product and they have the new MLI Select product. The standard rental is really that. It's your standard rental property. They're not taking a look at affordability. It's just, does it debt service, and where does the value come in? 85% loan to value with a 40-year amortization. So great options when compared to conventional financing. The rates are a lot lower as well too, which makes it a lot more competitive. On the MLI Select product, we're really looking more at affordable housing, which is definitely a need right now in the current market. Loan to values are a lot higher, 95% loan to value with up to a 50-year amortization. So that will help to offset some of the lost cash flow when you're working with a underperforming affordable housing type product, and make up with that amortization.
Absolutely, yeah. So guys, make sure that you pay attention to how you would like to exit, whether that be into a CMHC type product or a kind of more traditional lender. So do pay attention to that with your timelines so that you don't have a misstep there, or maybe you're just making sure that you refinance out into a different product to get into the CMHC long term. As long as you kind of have an idea of where you want to go, you should start planning early, just so that you can actually hit the timelines and the quotas that you're looking for. Anything else that we should know about this product?
Yeah, I think just to touch base on amortizations, it is limited to the remaining economical life of your building. So if you go out and you get your appraisal and it says 20 to 25 years remaining economical life, you're probably not going to get that 40 to 50 year amortization because the building isn't going to last the term of the amortization. So we want to make sure that matches. So if you're looking at 100-year-old building, chances are you are going to be a bit restricted with that amortization. And we see it often even on the conventional side. investors going into some smaller markets, Saskatchewan, New Brunswick, Nova Scotia, some of these small little cities on the outskirts, if it's a tougher market, older building, the lender might want to pull back on that amortization. And on a conventional side, you might not be at 25, maybe you're at a 20-year am. And same with CMHC, you may not be at 40, maybe you're 35 or 30. Again, but just being aware of where you're investing, how old the building is, that is going to affect your amortization on the purchase, if you can get it done conventional, and on the refinance. So again, keeping that in mind and understanding how to underwrite and where your expectations should be.
Absolutely, makes a lot of sense. Awesome. Anything else that we want to touch base on here with this product?
I would say just focus on your exit strategy more than your acquisition financing. Exit strategy is a long-term play where acquisition is a short-term play. So understanding your numbers, understanding your strategy, holding on to that asset, and when you're coming to us, that we can put together a solution that's going to allow you to be able to move forward with your investing strategies.
Love that. Awesome, guys. Well, make sure you check out part 1 of this video. We'll have that linked for you in the video description. And where's the best place for people to find you or reach out about this product?
All our contact information should be down below. You can reach out to us on our cell phones, our emails, Instagram, Facebook. We are pretty responsive with all that stuff, so feel free to reach out whichever way you prefer.
Awesome. Well, guys, stay tuned for more Canadian real estate content here on the Canadian Real Estate channel. Also, if you're not already, make sure that you subscribe to the channel just below and smash that like button and throw us some love down in the comment section below. We love to hear from you guys about what types of projects you're working on, what investments you have ongoing, and would love to hear if anyone actually uses this product and contacts the Findlay Mortgage Team and just hear a little bit about the process and how it goes for you. So toss some love in the comment section below and any questions that you have. And also hop over to the Findlay Mortgage Team YouTube channel. They have their own YouTube channel here on the interweb, so check it out. It's all about mortgage products, and make sure as well that if you're not working with a mortgage agent, that you do and work with one that understands what your goals are, because they are ultimately advocating for you, your goals, and that makes a huge difference in the long run and scalability of your business in real estate investing. So thanks guys for tuning in today, and we'll see you on the next one. Peace.